Sounds good. Thank you, Todd. And welcome everyone. We've got a great crowd today, a ton of information. So if everyone's brains aren't full by the end of this, I'll be absolutely amazed. So want to thank you for joining us today. Before I get started, Todd hit a couple of really key points that I want to stress. And I literally just celebrated my 13th anniversary here. I've been around Nadex a long time. And the reason I consider these key points, because they're often the most common mistakes I see in any strategy, binary options, even in the markets in general, but specifically with binary options. Always keep in mind that they're probabilities, they're not guarantees. And it's super important, as a mentor of mine once told me, he had been trading about 30 years. At the time, I thought that sounded crazy. This was like early 2000s, but now that I'm in about my 25th year in the markets, 30 years doesn't seem so long, time flies. But he mentioned, and I think a key point, whatever you're trading, whether that be Nadex or any markets, the ability to exit for a loss. If the market's determined you're wrong, and what my mentor told me specifically was there was no difference between him trading 30 years and a brand new trader. The only difference was that he got out of his losing trades faster. You'll hear me talk a lot about risk management, but that exit for a loss, and also never be afraid to take profits, to lock in those profits. And specifically, that's going to be something I cover here in just a little bit. But I really wanted to reiterate those points. And it's very important from a trading perspective. Be active, actively manage your positions. It doesn't mean you have to sit there and look at every tick. Some strategies, which we'll talk about, are great at kind of a set it and forget it type of thing. But if you've got risk on the table, you want to manage that. So with that, we're actually going to cover a couple of strategies today. I'm going to give you the basics and the foundation of them. Something you'll hear me also say is that you have to put in the work with these. That means you have to work in the demo environment. Don't just go in and you have your account and think, oh, hey, Dan said this. I'm gonna it's got to work. I'm gonna put it on this, all on this one trade, right? That wouldn't be good risk management. So with that, we're going to be talking about high and low volatility and a couple of strategies for those. We're going to talk about identifying market volatility, and then the two basic strategies. A lot of the time, though, is going to be spent in the platform. So, and thank you very much for the congratulations on 13. It's I don't know where time goes, but it's been a lot of fun, and I was passionate about Nadex before I was with Nadex, still am, because I think it's a great platform for individuals, and it's really all about access. To access the markets, access them in a sensible way, defined risk. Low capital costs. I can go on and on. I'm not going to do a Nadex sales pitch though, so let's talk about these strategies. Before we begin, trading involves risk. You're going to hear me say risk 90 times at least during this presentation. You put money into the market, you put money on a trade, you can lose all of that money. There are no guarantees in trading. We all have to take responsibility for how we risk our funds, managing those funds, and it should always be risk capital. If it is grocery money or rent money, I will almost guarantee you will lose all that money in the market. There's too much stress, the psychology of trading. It has to be risk capital. Very important. As far as the past webinars, when I get to the end of the presentation, I'm going to show you exactly where you can find those archives. By the way, I will answer questions as we go along. I may miss them, but I'll try to come back and make sure everybody's questions are answered. So identifying volatility. The first and key thing is price action. Just look at price. We're going to spend a lot of time in the charts looking at price. It doesn't take a genius to figure out if price is moving really rapidly or if it's kind of sitting there in a flat, dead market condition. I think anybody who's ever been to the beach, even if it was your first time, could tell if the waves were really big or if the water was more like glass. Same thing with the market. Exact same concept. It's all visual. To me, that's the most important part of any trading, is just look at price. What is price doing? Where has it been? Is it whipping around like crazy? If that's the case, and I'm looking at a normal strategy, maybe it's not going to work so well that worked in flat markets as what it did when the markets were crazy. A couple of other indicators that I like, and I like to keep my charts very simple, but with binary options, I think one of the most important indicators is actually the ATR indicator, the average true range. We'll take a look at this in the platform, but briefly, why I think this is so important is we want to be able to gauge if we're looking, as Todd covered, the various strike prices, and we're looking at those probabilities. The price of the binary option will give us those probabilities. We also can do our own homework, and we can say, wow, if prices, over the last, say, 2 days is moving on an average of 20 points, per 8-hour session, and all of a sudden today we're seeing it move 40 points, right? We know volatility has probably increased. It'll also give us a way to set targets when we look at those strike prices. Bollinger Bands are another great visual. I typically don't trade off of them, but they'll really give a great indication if volatility is expanding or contracting. There's also current volatility versus expected volatility. What I mean by that, and it's going to be everybody's responsibility, right? Almost every day in the market, there are various news announcements that are coming out. So a couple of big ones: Fed decisions, non-farm payroll is typically the first Friday of every month. CPI indicators, a lot of those can have an opportunity to really increase volatility. Right? So it's looking at where we're at, but also anticipating if the markets are going to become more volatile. Another one, I know we have a lot of technical traders on here. When we hit major levels of support or resistance, this can create a lot of volatility on its own. I remember when I first started trading and I was looking at support and resistance and I was drawing out my lines and I was like, okay, it's hitting support, it's going to bounce. And bam, it would break out, and it would break out violently. And so I thought, hey, I'm a great breakout trader, I should do that. And of course, then it would bounce, but it would bounce pretty rapidly as well. And so we're going to look at strategies that are actually direction neutral. We're either looking for the market to move a great deal or not at all. But again, we can see a lot of volatility. So if we're approaching major levels of support and resistance, that can also create its own volatility. So low volatility strategy. And this is going to be the basics. Again, I like to spend time actually looking at the platform. And I encourage everyone, when you're testing this out, work on it in your demo first. One thing about a demo account though, and this is an old saying, you can practice in a demo account, you can practice the basic functionality. So you practice in a demo account, you actually learn in live. The market is full of lessons. That's why it's important when you're getting into the live, low risk, define your risk up front. So we're going to talk about these strategies as far as if there's low volatility, right? Just means price action is minimal. We might have a slowly trending or a flat market. Sometimes it's range bound sideways. In the case of a low volatility strategy, we're going to be looking for what's called time decay rather than market movement for us to be profitable in our trades. We're typically risking more, as far as full risk, risking more than what we're going to return, but it's all about that price decay. As Todd mentioned, that's either going to settle at 0 or 100. So we're looking at the market to either stay where it's at, or if it's moving up slightly, continue to move up, or if it's dropping slightly, stay at least where it's at or drop slightly. And so there's a basic structure for this. And it's about using in the money binaries if you're buying, meaning I'm going to buy a high probability binary, or what we'd consider a high probability. Again, it's not a guarantee, right? Price is a probability. And we're going to be looking to buy those between a level of 60 and 80. We could buy a little bit higher than 80, but as we start to get higher, it's going to kind of eat into that capital. Also, though, if we're buying at 60 to 80, this is a strategy that you want to watch, right? Because if you buy at 65, you're risking $65 on that position, not inclusive of exchange fees. So if it starts dropping against you, you're going to want to get out for a loss. You don't want to take that full loss. On the sell side, we could sell an out of the money binary, something that the market is saying is a lower probability, which in effect means a higher probability of going to 0 than to 100. So we'd be looking to sell between a value of 20 and 40. Or we can do both. And we're going to walk through how this is set up on the platform. So we could buy an in the money and sell an out of the money. We're looking to collect that premium. Basically, we're looking for the time value to totally erode. On the opposite side, we have a high volatility strategy. And when I say high volatility strategy, I'm actually looking for volatility to increase. I could get in when the markets are relatively calm, but I might be looking in front of a news announcement, or maybe I'm coming up on those major levels of support or resistance, right? I'm looking for a breakout or a bounce. So we're looking for volatility to increase. Almost one of the worst things for this high volatility strategy is to get into it when the market's already volatile. Anytime with any type of option contract, which is what binary options are, as well as what we'll talk about later this afternoon on the call spreads, it typically costs you more to get in when there's more volatility, or you don't get the movement. So we're going to look in the high volatility strategy when we go to the charts for volatility to be moving, actually to be in a flow from a lower volatility to a higher volatility environment. Here's a few guidelines. I typically, because we're looking for movement, and again, these are guidelines, you're going to want to execute the trade at least 30 minutes before an event. So if non-farm payroll, which is scheduled for 8:30 Eastern on a Friday, happens, you probably want to be getting situated into this trade at least 30 minutes prior to that. What happens prior to events is volatility already starts to increase. We get what's called price compression. So again, these are guidelines. You have to put in the work yourself. This case, we're going to look to buy low and sell high, but we also want to take profits. We want to lock in profits. When you have a market that could be really volatile, a trade that is all of a sudden you're very excited about and you're showing a lot of profit, that can all be taken away very quickly. And so we're going to look at what I call, or what's called, scaling out of a position. In the case, if you're looking for volatility, but volatility doesn't happen, we've all seen it. All of a sudden, the markets, everybody on the news channels are talking about these big events that are going to come out. And then it comes out and it's just a dud. It was just right at expectation. The market doesn't move. Just get out of your trade. While we're actually taking on low risk, the whole premise of this strategy is low risk, high potential return. If the market doesn't cooperate with that, the market's always right. We just need to realize, hey, it didn't happen this time. Let's cut our losses, because even if I buy something, say at $20, I'm risking $20 with a potential return of 80. Well, if it doesn't happen, why do I want to give up that whole 20? Maybe I can still get out of it at a loss of 10. When you're trading, always think about not this trade in a vacuum, but think if you apply the same techniques over 1,000 trades. You start to talk about real dollars. And it goes back to the point I was making earlier about getting out of those losses faster. Very important premise. In the case of this strategy, and actually in a lot of strategies, I think multiple contracts per side are better. And I'll cover this more in depth when we talk about scaling and why I feel that's really important. Reiteration, always, 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 always use limit orders to lock in profits if you're in a volatile environment. Again, because it can just whipsaw so fast. In this case, we're going to be looking at selling in the money binary. So this is exactly the opposite of the low volatility strategy, which is why I like to put them together. I want to give you a couple of tools for all different market conditions. So we're going to sell a binary at 75 or higher. We're going to look to take profit at around the 50 mark. We're going to also, right afterwards or right before, we're going to buy what's called an out of the money binary option at a price of 25 or lower. Right? We're looking for those, what would be classified maybe as those longer shot type of trades, but we don't want to sit there and wait for it to go to 100. This is about trying to lock in profit right away and then letting the rest of the strategy run. We're going to use those limit orders. And the reason I say, or the basic rule of thumb is you want to take profits right around that 50 mark. Basic rule of thumb for binary options is that if price is trading around the strike price, right about the strike price, it's considered at the money. By probability, it should trade somewhere right around the 50 mark. Now, I'll say with time remaining. As Todd illustrated on the 5-minute contracts, they can move really fast. But if we're trading, say, a daily binary option, and we're doing this in the morning, and you can implement this strategy the night before, oftentimes that's great because you can lock in profit overnight while you're asleep. You've got low risk. And then if the event, let's say we set this on a Thursday night before non-farm payroll Friday, you might get the market movement overnight to lock in some profit for you. And then you get the movement of the actual announcement that can actually create a whipsaw, and maybe you lock in profits on both sides. These are the basic structures. Now, I'm not going to test you on this because if you're like me and are very visual, you need to see it. You actually need to see it, and you need to do it yourself. So let's take a look at these in the actual platform. All right, you should be seeing the trading platform right now. Can somebody just confirm that? I want to make sure when I switched away from the presentation that, okay, perfect. I'm going to take a sip of water here. I've been talking all morning. By the way, I just gave you a sneak peek of how my chart was set up for the afternoon's presentation. So hopefully nobody caught that. So the first thing we're going to do, let's talk about the low volatility strategy first. And we can see this market is kind of moving. I'm going to bring up the ATR indicator because right now I can look at this, and this is a 5-minute chart. By the way, multi-timeframe analysis. Does anybody know what I mean by multi-timeframe analysis? To me, it's one of the most important concepts in trading. Just seeing some answers come across. Perfect. So has anybody heard the saying, you can't see the forest for the trees? Think of it this way. When we look at our charts, a lot of people will execute trades on a shorter time frame, like a 5-minute chart. And I know some people will only trade off of a 5-minute chart. They just look at the 5-minute chart. The issue I've always had with that, or the difficulty I should say that I've had, is it doesn't give me a clear picture. You don't get all of the data of what's really happened historically. Think about it like this. If you're, the old saying, right, that I used just a minute ago, can't see the forest for the trees. If you're standing in the middle of the forest and you're lost, your perspective is all of the trees that are around you and not much more. It's very difficult to find your way out or to really understand a directional basis. That's the 5-minute chart. But if you look at, say, an hour time frame, you're getting much more data. So it's like having a map of the overall park. It's going to be a lot easier to find direction, trend, what has been the historic highs and lows. The beginning, I rarely trade off of a daily chart, but at the beginning of a week, it's always good. I like to look at the daily charts. I like to get a big perspective of the market. A good friend of mine who runs an education program always says, if I make a mistake in the market, it's often because I haven't looked far enough left. Yeah, I'm not doing anything on the chart so far, so it's just ticking away. This is actually a little bit longer time frame. So what I mean by this is an hour-long chart, or excuse me, each candle is 1 hour. I'm just going to add the average true range. So this is going to give me an average of where the markets are at. Clearly, this line is over the weekend, but what we're looking at on any given hour, this particular market, which is the Euro USD, is probably moving somewhere, and I'm just going to put my line in the middle, of around 14 points. Now we can quickly see, just by looking at price action, of where the market's got a bit more volatile. And let's scan this in. So we've gone to a 1 hour. We've got our 1 hour candles. This is this week so far. I could go out to a daily. And again, so if I'm looking at this at the beginning of the week, the most recent low was put in here right around 118.28. Had a high up here around 122.42. I'm getting a lot of data. I'm actually going back to the beginning of the year, and I can mark these, what we'd call key levels previously. So this gives me a broad perspective of what the market's doing. Now, if I'm looking to be in a trade, I'm going to move back to the 1 hour chart. And let's say I'm day trading. So I'm expecting, the market maybe to be in a trade. I might be in a trade 15 minutes. I might be in a trade 2 or 3 hours. Maybe it's a trade, actually, if I'm trading weeklies, that could run a little bit longer. Let's just say I'm expecting to be in a trade for about 3 hours. Again, everybody's a little bit different. If I look at this right here, right, we saw some volatility here this morning, and I gauged that just by looking at these previous candles. Again, price action. What is price doing? Saw some volatility this morning, but it's looking to move on average, and as we looked at it more historically, about 14 pips. This is the currency market, 14 pips per hour. So if we're looking at a strike price that, say, is 100 pips away, we'll make the math easy, 100 pips away, and I'm expecting to be a trade for 3 hours, probably a pretty low probability that that'll happen. And we see that represented in the binary option price. So what we kind of have now using the ATR, the average true range, and just price action, we can see that we had a bit more volatility. Now we also have to understand the time of day. When are markets most volatile, particularly when we're looking at something like the Euro USD pair? They're going to be most volatile typically in the morning when the European session is really active, as well as the US markets are opening up. That's when you're going to get the most volatility. As we get into the afternoon here, markets tend to, and I say tend to, no guarantees, tend to slow down. So now we have an idea, 14 pips per hour. So I'm going to move down now to the 5-minute chart. And I'm going to take a look here at the 5-minute chart. So far we put in our daily low right down here, and I'm just going to snap a couple of lines here. I like the binary option lines on the chart because they actually give me the support and resistance. But if I just want to do a horizontal line, I can put that on the chart at this level. I can do another one perhaps up here at the daily high. I'm going to get rid of the average true range now just to open up a bit more room on the chart. So again, this is the low volatility strategy. In this case, I could do a couple of things. Again, I'm looking for time to erode the price. We had a bit of volatility this morning. Perhaps I'm expecting it to slow down. This one, it looks like we're still getting some decent movement. Right now we're trading at 118. I know the chart's probably a little bit small here, so I'll call out the numbers here. Right now we're trading at about 118.91. We've got 118.80, which is the next strike down, and we've got 118.60. So this one is about 48 pips, or excuse me, 38 pips, 30 pips below. If we're moving 14 pips per hour on average, right, we have a pretty high probability here. So I'm actually just going to execute a couple of trades, give you an idea. So I'm actually going to buy this one. What I would literally be looking for, though, is a reason that I believe that the market is going to stay above this level right now. And I'll dig into this actually a lot more in the afternoon session when we're looking at the full thing. But let's say that I have a couple of points of support right here. I think it's going to stay above this level. We had a big drop. For some reason, I have an indication that I believe it's going to stay above this level. Again, this is just an example. I'm in my demo account. I'm going to show scaling here. So I'm going to place 5 contracts on this. So right now, I have a maximum potential loss, not inclusive of exchange fees, of $357.50. Maximum profit of $142.50. Again, this is just an example. So I placed my order, and let me adjust this. The market moved. I'm going to switch to a market order here, and just place this order. I just placed 1 contract. So I've got my position on. I'm showing a $1 loss. Now, as time decays, as time erodes, this price will move. And I'm going to switch to a shorter term contract here. This price has to either go to 0 or 100. So if I'm in this trade and I bought at $71, $72 roughly, I don't want to watch that go to 0. So there's still quite a bit of time left in this contract, but I don't want to sit and wait for it to go to 0. So if price starts to drop and it comes down here, remember the rule of thumb: if price is at the binary option level, strike price, it should trade around the 50 mark. So real quick, because I know a lot of people are new to the platform as well, I want to show how to exit a trade. So as an example, price is moving against us. I just click on my open position, and if I'm getting out, I like to use a market order. I'm just going to exit. I'm going to switch to a shorter term contract here, so we can get a little bit more of an indication here. So allow me to refresh my charts real quick. Is the white background a little bit easier for people to see, or do you prefer the dark? Cool. I will switch it back in a second. Let me bring these up here. Oh boy, we've got okay. We've got actually some votes for all of them. A lot of votes coming in. Well, for some reason now I'm not able to switch back to my dark. I will see that in a second. Price line. Well, looks like we're dark UI. For some reason, this changed on me, and I'm not sure if it's because I'm in the webinar. So we might have to.
Down in the down on the left hand, the settings in the left hand corner.
Thank you.
There you go. And then there you go.
Okay. Thank you. You know, I've only
hide
been here
it from you.
I've only been here 13 years, and I actually helped develop this platform.
That's new functionality. Fair is fair.
Yeah. Thank you. I was having complete brain freeze there. Okay. So it does look like the dark theme won. So what I've done here, and I'm going to go back to the markets. If I'm looking for this, this is a day trade. I'm going to go to this contract and look for one. You know what? Because we're doing this, if I look at this contract, and one of the things that you'll see on the shorter term is, right, as time decays, you may not have the options. If I look at this, I say, wow, based on my rules, I can't really buy this one at 99.75. First of all, never buy a contract at 98 or greater. Does anybody know why? The exchange fees will take away all of your profit, right? They're low, they're $1, but if you successfully buy a contract at 98 and it goes to 100, you've actually just broken even. It might surprise you, but I've seen plenty of people that do that. And I've talked to plenty of people, and actually one person, I still remember them, their whole reasoning was that they just wanted to be right. This is another mistake that I've just seen way too many people in the markets make over the years, and it never fails. I'll call them up, and I was trading coach for a long time. I'll call them up and say, hey, you know, I looked at their account and they had $5,000 and now they're down to like 2,000. And I call them up and they're happy as can be. And I'd be like, so how are things going? And they're like, oh, fantastic. I am right 75% of the time. Well, that makes you happy because you just lost 60% of your account. They're like, yeah, but I just have a few tweaks to make. It is never about being right. It is about being profitable. That is about trading. Some of the greatest traders I've ever known are correct 10 to 20% of the time. They just get out of their losing trades faster and manage their positions when they're making money. So yeah, I'm going to go through the whole entry exit process here. So in this case, I don't have an opportunity. What do I do when I don't have an opportunity? I look for a different opportunity. So I'm going to go to this daily expiration here. And this could be a directional trade. Right? So right here, this is the same. Oh, this is Euro GBP, excuse me. Let me go to Euro USD that we were looking at before. Here we go. I'm going to look at this. This is basically the same strike that we were looking at before. So right now we've kind of come close here. It's going up. We've got 1 hour, 27 minutes till expiration. I'm going to actually place a couple of trades here. I'm going to buy this 72.50. I'm going to show you a couple of concepts here. I'm going to buy this 72.50. I'm going to click place order. So my maximum loss, 362.50, maximum potential profit, 137.50. So, okay, I opened that position. So right now, this is what we call a single leg trade. I just have one position on. So I bought this for 5 contracts. My profit and loss is already negative, as it will be, because to account for the bid offer spread. So now I could just sit here and watch this. If price goes up until expiration, I collect the premium, and that premium is basically the difference between where I bought and 100. If price drops and continues down like this, but still expires over the line, it still settles at the full value of 100. In this case, I'm looking for it to go to 100, or in the case of 0, I'm selling. So right now, I've got $362 of risk on. I'm going to look, though, for another one. In this case, I'm going to say, wow, you know what? I don't expect it. And again, we do some more analysis. We'd look. The question is why limit and not market? I actually love using limit order, so mine is just set to default. Nothing wrong with the market order. As a matter of fact, typically when I do these, I switch my default to market just to get the extra execution. I actually, here's another thing everybody should keep in mind. You don't just have to take. So right here, I have a buy and a sell of 80. You don't have to take that. Oftentimes you can what's called work an order. So I could put a limit order instead of selling this at 73. Maybe I want to sell it at 76. I might not get a fill. I'll show you that concept in just a bit, but I'm just going to execute this trade here. So I've got 5 contracts. So now I basically have a trade on where I'm expecting price to stay between these 2 levels. Let me scroll up here a little bit. So did I place order? So now I'm expecting price to stay between these 2 levels. See the red flag there and the blue flag? Both of them can't be wrong. Because if price settles below this, I make money. If price settles above this, I make money on that trade. Now, I want to take a look at, though, if it starts getting close to 1, I might want to close out. Right? So if this goes to, say, starts going up to 40, I might want to close that out because that's about a $13 loss. But if that goes to 40, that means that this one is probably getting closer to the 100 mark. So I want to sit here and I want to watch this because basically I'm looking for my upper position here to go to 0 and my position down here to go to 100. Does that make sense? So the great question here. Why is my risk higher than my potential profit? Because both of these trades have the probability of finishing in my favor. Now, again, it's a probability. So I'm looking to collect a small amount of money, but I'm putting up more risk to do that. So in this case, though, what I'm doing now is if the market just sits here, both of these trades would pay out. Right? So if the market just stays in this range, it doesn't matter if it moves at all, right? We're just looking for that. Yeah, and that's a great one. I'm risking more because I've got probabilities on both sides. So but again, this is why you want to manage this particular trade, right? Because you have more maximum potential risk. You don't want to watch all of your profits erode because of that risk. So you want to actively manage this trade. I'm going to show you something real quick. Actually, you know what? We'll talk about a volatility strategy. Real quick, I'm going to show you how to get out of these trades, right? So right now you just click on this position. So I click on this position. It opens an order ticket in the opposite side of my trade for the full amount. Place order. I'm going to show the yep, you called it the strangle. Strangle is next. All right, so I'm just going to close this one out. Now we're going to go to the volatility strategy. And this is one, and Todd, I promise I'm not going to run too long, but I'm going to show these concepts. So this is one where we're actually expecting a lot of volatility. This is one maybe we'd put on the night before. I'm just going to run through some example though of executing it. So in this case, I'm looking for market to break out in one direction or the other, or maybe do a big whipsaw. Right? So in this case, I am selling. I'm going to put on 5 contracts here. I am selling and in the money. So I'm selling. Right now, I'm putting up $130 risk for a total max profit of $400. And out of respect for time, I'm going to do this. I'm going to now scroll up here. And this one, you know what? I'm going to do this one at 1825. I'm going to click on that one. I'm going to do 5 contracts. Place order. So now I have a couple of ranges. So basically what I'm doing by this trade is I'm expecting price to go at least to one of these levels. Right? So if I'm looking at a Fed decision, maybe there was a Fed decision this afternoon, it would be, you know, I might be looking for volatility. Right now, it's not a strategy I would probably execute with an hour 20 to go when the markets are kind of slowing down. But I want to give you the basic concepts here. This actually, and the reason why I say a lot of people that trade this will put it on the night before they're expecting volatility. So in this case, if price hits one of these lines, and again, general rule, no guarantee, but general rule, if price goes to one of these lines, it should trade around the 50 mark. So because these are lower probability trades, I don't want it to go, I don't want to sit and wait and hope it goes to 100 or hope it goes to 0. So what I'm going to do is put a couple of limit orders on it, and I'm going to show you a concept of scaling. So I'm going to go to this one that we bought. We bought it basically at 1850. So I have a position size of 5 contracts. Let's say that I want to take profit on 3 of those. I'm going to try to take profit at 47. Now, does anybody know why I'm taking profit at 47 rather than 50? Excellent. So, yeah, perfect. So the reason I'm doing it at 47 is because if it hits that price line, the midpoint should be somewhere around 50. So I'm looking to lock in my profit a little bit before that on the buy side. So I'm going to place this order. And what I've done here is now if price shoots up here, shoots up and to this line, I've locked in profit on 3. Because if we're expecting volatility, so to answer the question, how do we know when something's volatile? In this case, it's something that we're looking for. We're looking for volatility to pick up. An impetus for that could be a big fundamental announcement. I'll show the website in just a moment, but I love the Daily FX website for news announcements. So we can take a look at that in a second. So that's one of the tools that we use to determine if something could become volatile. In this case, though, volatility can shoot in one direction and then just as easily reverse. That's why we want to lock in profit. You don't want to sit here and say, wow, I bought something at 18 bucks that all of a sudden was worth 60 and now it's worth 25. So we lock in a portion of the profit here. So we had 5 contracts, price shoots up to the top here, locks in our profit. That way, if it drops down, okay, we're not worried. We locked in some profit. We actually made a profit on the overall trade because our profit was greater than our risk on the other side. Or in a great world, price continues to go up, stays above that line, and the remaining contracts settle at 100 for their maximum value. All right, on this one, right? So we have this one that we sold. So I'm going to open that one. We sold at 84.50. In this case, I'm going to do the same thing, 3 contracts, but this one I want to buy back at 53. One of the reasons why a lot of times from people that I've talked to that implement this on a fairly frequent basis, love to do it the night before, is here's why. A lot of times what'll happen is price will drop overnight. They're sleeping. They get filled on these 3 contracts. Maybe price continues down and all of a sudden they've got a really great trade. But price comes down, drops, fills their contracts, maybe comes back. An announcement that they were looking for comes out and all of a sudden it shoots up and they take profit on the other side as well. So where on the original strategy, there was the potential where they both couldn't be wrong. They could both be right. Similar premise here, where you can actually lock in profit, but both of these can't settle at the same thing. One of them is going to be wrong. You're just looking to maximize profit on the other side. But sometimes you can lock in profit on both sides. And let's see, I know we're getting close here. Let's say the announcement comes out. I want to walk through another basic concept. Let's say the announcement comes out, nothing happens. It's boring. We're just sitting in the middle, right? So I'm down some money, right? I've lost a little bit. This one that I at 84.5, I could let it go to 100, but that's the full loss. I'm just going to close this out. Take a smaller loss. All right. Same thing. I thought, I determined I was wrong on here. I don't want to take, even though it was low risk to begin with, I don't want to take the full loss. I'm going to close that out. I'm not done yet. There's something I really want to stress. I closed out my positions, but one thing I always want to double check before I leave my platform, and trust me, I have made this mistake. Even after I've been preaching it for years, I've made this mistake. I forget to close out my working orders. Always make sure that you delete those off the list. So I know we've got a few minutes here. I want to be respectful of Todd and give him some time.
You got another 5-6 minutes. You can go. You're good. I'm going to make sure you cover it all.
Oh yeah, definitely. So yeah. Somebody, can you do? Yeah. So somebody wants to take a look at the indices here. Same concept. So whatever you're trading, this isn't just for the daily. So in this case, and I'm not doing any analysis here. I'm going to buy this one at 1875. Just put on a market order. I'm going to do a size of 5. I'm going to place that order. So this is called a strangle, by the way. So I bought one cheap. I'm going to sell this one at 82.50. I'm going to do a size of 5. New market and place order. So I've got 2 positions on now. So what we're basically looking at, and again, this is just an example in the demo account. So we've got these 2. Now I want to look in. Oh, hey, that's a great question. Actually, a suggestion that said exit market and cancel orders button. That's in the works. So I'm happy to say that. Yeah, that is one thing. The reason I'm stressing it now is it's not on the platform yet, but that is in the works. So I couldn't agree more. Cancel all. I don't have a specific time frame. One thing I do want to stress, when you're on the platform and there are things you see and you say, hey, like this is an example of a great suggestion. It's one we've heard and we're responding to. Over here on the feedback button, right? If you have platform feedback, click on that, send it to us. We pay attention. Almost everything we do in design is prioritized by feedback from our members. So I want to touch on that because that's something that's going to be coming very soon, where you can cancel all, you can exit all your positions, and cancel all, you can exit a position. It just makes it a little bit clearer and easier. All right, so real quick, I'm going to place some limit orders here. So I'm going to do this again, simple concept. I'm going to place 3. I'm going to go to my other one. I'm just going to click for now on my open position contract. Opens on the opposite side. Try to take profit on this one. 3. Click place order. And one of the things with this strategy now, so let's say it was, again, it's evening time. I'm getting ready to go to bed. I can walk away from this trade. I've got my maximum profit. I know what my maximum loss is. It's very acceptable. It's very low. Got a great potential upside. Whereas when we looked at the low volatility, that's one you don't really want to walk away from because things can change quick. Real quick, a question on fees. So to execute this trade, so the fees are $1 per contract. So on this one, I did 5 contracts. So that's $5. On this one, I did 5 contracts. That's $5. If, let's say, this limit order gets hit, that's $3. Right? I have a position size of 3. If the remaining 2 settle in my favor, there's a $1 exchange fee. On a binary option, if it settles for a complete loss, there's no exchange fee. So that's a brief overview on the fees. And I'm going to hop into the website here real quick, and I can show you where you can find those. All right, so real quick, I'm going to go to our homepage because that's probably where everybody will start. So a couple of things. If you want a glossary, if you want to know what these terms mean, click on the glossary, right? The learning section, because I see some questions about accounts and different things. How do markets settle? Various platform tutorials. A lot of great stuff here. If I want to, also at the top here, you'll see some upcoming webinars. I can go to the webinars page. So these are all the upcoming webinars. Simply register right from the page. Or if you want to search in the archive, you can search all of these. You can look for call spreads, binary options, filter them all out, what you're interested for. There's a lot of information, a lot of content. And finally, the blog page, where all different topics, right? I mean, just tips for new traders. We continue to add to this. You know, what is the legality? Nadex is regulated by the CFTC. So you need to understand that you should be trading on a CFTC regulated exchange if you're looking for binary options. Oh, real quick, and then I'm going to wrap it up for Todd. I'm going to hop over here. I mentioned the calendars, economic calendar. So this is dailyfx.com. Go to the economic calendar. You can see everything coming up for today, tomorrow, the next 7 days. It'll tell you the impact typically on the markets, low, medium, high. So if you see these high ones coming out, so this particular one is out of the Euro area and specifically Germany. So if I'm trading something like the Euro USD, this report might have a big impact on that particular pair. And with that, I think I covered all of the all of the questions. If not, we do go through these after the fact, so you may get an email from me apologizing for missing your question. It's also being recorded. But with that, I really want to really thank everybody for joining. Great group, great questions, great suggestions. I also want to thank Todd for helping me to find the theme setting on a platform that I've been intimately involved with for at least the last year and a half. So thank you all. I will catch you this afternoon with one that I think you're really going to like on a basically what is a divergence strategy.